Welcome to The Explainer. Today, we're diving deep into a massive structural divergence in the global financial system. We're calling it the 180-degree angle. Look, right now, headline stock indices are absolutely screaming prosperity, right? They're painting this picture of unparalleled economic strength. But if you peel that back and look closely at the ground-level indicators, the real economy is actually facing a technical depression. We're going to uncover exactly why that is and why a company that builds washing machines might honestly be the most accurate crystal ball we have right now.
So, let me pose a question that sits at the very core of this whole contradiction. Is the S&P 500 lying to you? I mean, really think about it. Why is the broader market hitting all-time highs while the companies that manufacture the physical goods we use every single day are sounding the alarm? The disconnect is just staggering. The stock market is acting like we're in this roaring economic boom, yet the physical economy feels like it's completely frozen. Let's look at the actual numbers. On the left side here, we've got what I like to call the digital mirage. The financial news cycle is just relentlessly highlighting the S&P 500's incredible earnings. They're framing it as the best corporate performance in 20 years. But then on the right side, we have the kitchen sink reality. Whirlpool Corporation, a centenarian industrial giant, just reported a brutal 10% year-over-year revenue collapse. So you have to ask yourself, how can the S&P boast its best earnings in 20 years, while a foundational appliance giant faces a 10% revenue collapse? How is the economy booming if the average consumer has completely stopped buying big-ticket appliances? Well, that's exactly the mystery we're going to solve today. Here is our roadmap for today. We're going to quickly break down 1. The S&P 500 mirage, 2. The kitchen sink depression, 3. The consumer death zone, 4. Unpacking durable goods cycles, 5. The late cycle equity trap, and finally, 6. The brutal truth ahead. Let's jump right in. Okay, Section 1, the S&P 500 mirage. Let's talk about market concentration. Almost 40%, 36.4% to be exact, of the entire S&P 500 is currently driven by just 10 mega-cap names. And within that tiny group, the big two, Amazon and Google, are doing the heaviest lifting. Guys, we haven't seen market concentration at these levels since the 1950s and 60s. So when you hear people say, oh, the market is up, what we're really hearing is that a handful of digital and AI-focused giants are up. It completely masks the struggles of the other 490 companies in the index. Let's look at the math over a 3-year trailing period to really prove this. The standard S&P 500, which is market cap weighted, meaning the bigger a company gets, the more influence it has, is up an incredible 72.04%. But compare that to the S&P 500 equal weight index, which is only up 39.94%. That is a massive 32-point performance gap. Because the equal weight index gives every single company the exact same slice of the pie, it completely strips away the distortion of those top tech giants. It exposes the reality. The other 490-plus American corporations are seriously struggling. They are literally not participating in this incredible rally. Moving on to Section 2, the kitchen sink depression. Let's unpack Whirlpool's disastrous Q1 2026 data. All right, let's shift away from the digital economy and step into the physical economy for a second. A 96% drop, that is the year-over-year profit margin collapse in Whirlpool's core major domestic appliances North American segment. I want you to just let that sink in. Their segment EBIT margin fell to a staggering 0.3%. When a century-old foundational manufacturer sees its domestic profit margins effectively wiped out in a single year, that's not just a minor blip. No way. That is a blaring siren signaling an industrial depression. Across the entire company, Whirlpool's ongoing EBIT margin sat at a very healthy 5.9% in the first quarter of 2025. Just 1 year later, in Q1 2026, it compressed all the way down to a mere 1.3%. And management was incredibly transparent about why this happened. They faced severe, unfavorable price mixes. Essentially, consumers just completely pulled back, which forced Whirlpool and its competitors into a highly desperate promotional environment just to move inventory off the lot. They had to slash prices just to keep the factories running, basically destroying their profitability in the process. See this beautiful, high-end kitchen? Notice how completely still it is? This visualizes the frozen state of big-ticket discretionary spending in American households today. And management didn't sugarcoat this at all. They explicitly called it a recession-level industry demand collapse. The average family is simply not buying that new $2,000 refrigerator right now. But we need to ask why. That brings us to Section 3, the consumer death zone. the lethal intersection of falling revenue and rising yields.
Let's formally define what we mean by the consumer death zone. It's this widening macroeconomic gap where durable goods revenue falls precipitously while the 10-year Treasury yield continues to rise. Think of it like mountaineers trying to climb Mount Everest. You know how once you pass a certain altitude, there simply isn't enough oxygen to sustain human life for very long? Well, the consumer is in that zone right now. With 10-year Treasury yields sitting high at 4.392% in early 2026, combined with collapsing consumer sentiment, the average household simply cannot survive the financial pressure. To put it in perspective, Whirlpool's revenue fell 10% while the 10-year yield pushed even higher. That widening gap, that's the exact definition of this oxygen-starved environment.
Now, you might be wondering, why does that 4.392% 10-year yield matter so much to a washing machine company? Well, because the 10-year Treasury is the direct benchmark for 30-year fixed mortgages. When that yield stays high, mortgage rates stay well above 6.5%, and that completely destroys housing turnover. If people aren't buying new houses, they aren't buying new appliances. Furthermore, high yields reduce general credit availability, which kills discretionary upgrades, and they signal long-term inflation, which increases the raw material costs for the manufacturer. It's just a perfect storm.
Section 4. Unpacking durable goods cycles. Let's look at the mechanics of the big-ticket purchase.
To truly grasp why Whirlpool is such a powerful leading indicator, we have to analyze how and why consumers actually buy major appliances. There are exactly 3 reasons. Step 1, replacement on failure. Your fridge dies, you gotta buy a new one today. This is the absolute floor of the industry. Step 2, replacement on move. You buy a new house and upgrade the kitchen. As we just saw, this is highly sensitive to mortgage rates. Step 3, discretionary upgrade. Your fridge works fine, but you want the fancy new smart screen version. This relies entirely on consumer sentiment and disposable income. Right now, because the housing market is frozen and consumer confidence is wrecked, steps 2 and 3 have completely vanished. The entire appliance industry is resting purely on emergency replacements.
And why is sentiment so wrecked? Beyond the high interest rates, we have to factor in external shocks. Management specifically pointed to the late February 2026 outbreak of conflict in Iran. This geopolitical shock drove massive global inflation fears and absolutely shattered consumer confidence in March, driving it to record lows. Combine that with huge regulatory confusion over Section 232 tariffs and competitors stockpiling cheap Asian imports, and what do you get? A consumer base that has initiated a massive, defensive retreat in their spending habits. I mean, when you're worried about global conflict and tariffs, the last thing on your mind is upgrading to a smart fridge.
Section 5, the late cycle equity trap. Let's connect this back to historic bond market signals.
This right here illustrates the classic yield curve inversion cycle. Normally, you get paid more interest to lend the government money for 10 years than for 3 months. That makes sense, right? But when that flips, when short-term rates are higher than long-term rates, it's an inversion, and it almost always signals a recession. But here is the trick. The recession doesn't usually happen during the inversion. It happens during the recessionary lag, which is typically 12 to 18 months after the curve uninverts. Look at the timeline. The yield curve uninverted in late December 2024. Count forward 15 months, and boom, Q1 2026, the Whirlpool revenue collapse arrives exactly on schedule. The bond market warned us, and the physical economy is now paying the price.
And the pain down here is visceral. Look at the brutal reality of Whirlpool's Q1 2026 cash conversion. They reported a negative $896 million in free cash flow. This immense financial pressure forced the company to make a very tough call. They suspended their dividend to prioritize paying down debt. When a blue-chip industrial staple suspends its dividend, that tells you absolutely everything you need to know about the durability of the current economic environment.
Finally, Section 6, the brutal truth ahead, the ultimate verdict on where this market is heading. Look, millions of investors blindly pour money into S&P 500 ETFs every 2 weeks, forcing these funds to buy the largest companies regardless of their actual valuation. It creates this massive liquidity trap, because when the momentum of the big two, Amazon and Google, inevitably breaks, the top is so dangerously heavy and the rest of the market is so weak that there simply won't be enough active managers stepping in to catch the falling market. There's no floor. And that is exactly why we call this the 180-degree angle. Whirlpool's distressed state, their 1.3% operating margin, their suspended dividend, that is the honest economy. It accurately reflects a world with high treasury yields and shattered consumer confidence. The S&P 500's record highs, they're a digital mirage, mathematically skewed by a handful of tech giants operating in a total vacuum. The data is screaming that a massive systemic recalibration, a mean reversion, is straight ahead.
So I'll leave you with this final thought to ponder. If you are blindly riding the momentum of cap-weighted index funds, assuming the broader economy is just as healthy as the top 5 tech stocks, you might want to take a hard look at your kitchen appliances and think again. Because when that digital mirage finally fades, what real-world foundation is going to catch your fall? Thank you so much for joining this explainer, and remember to keep your eyes on the real indicators. Catch you next time.